Manishi Raychaudhuri is now with us. He's a veteran investor. Mr. Raychaudhuri, great to speak with you, and thank you so much for joining us this afternoon on NDTV Profit. I'm just wondering, what really do you think is the pain point here? Is it the same narrative we've been seeing the last few days of FIIs fleeing or flocking to China at the cost of India?
It's a combination of several things that have hit the Indian market. First, the geopolitical tensions in the Middle East have been, sort of boosting energy prices, oil, and India, as we all know, is one of the biggest importers there, potentially, therefore, leading to expansion of the trade deficit and kind of forcing a weakness on the currency. Second, as we now all know, the stimulus measures announced by China have led to more than a 30% spike in the market over last week. And it has brought back a significant degree of foreign investor interest into this previously unloved and, under-owned market. So when you put all these things together, it's quite, it was kind of expected that an overvalued market like India had to correct. We have seen about, I think, a 5 to 5.5% correction over the past 1 week. But I would also think that this has a silver lining. In the process, while, Greater China has moved up by 30% or more, Asia ex-Japan itself has moved up about close to 12 to 15%. India has declined about 5 to 5.5%. Therefore, the relative value premium that India had, and it was quite a severe premium, that has compressed, that has declined. So, if this situation kind of continues, or if India's valuation premium shrinks a little more, I think institutional investor interest could come back because the longer-term fundamentals of India have not really changed.
So Manishi, since you have the choice of doing everything, maybe a week ago, 10 days ago, good afternoon, of course, Neeraj, a week ago, 10 days ago, you may have chosen to go to China. Now that some bit of that difference has been corrected, where does incremental dollar go? Does it still go largely into China or some of the other markets, or does now India also become a fishing pond?
I think, at some stage, we're kind of getting closer to that point where, foreign institutional investor interest into India would come back. Maybe the relative valuation needs to compress a little bit more. Now, coming back to your original question, where does the incremental dollar go? The Chinese market was so amazingly under-owned and undervalued. If you look at MSCI China, it was trading at between 9 to 10 times, while the longer-term average was about 13 to 14 times. If you look at Hong Kong, the Hang Seng Index was between 8 to 9 times. It's just gone to somewhere close to about 10.5 to 11. There are still extremely undervalued, cheap stocks in these markets, which are trading not just in single-digit PEs, but also anywhere between 6 to 8% dividend yields. And there's a sizable population of such stocks in both onshore China and Hong Kong market. So I think the interest of investors in the Chinese market would not really abate right away, just because the market has moved up about 30%. Maybe the easy money has been made, but the interest would still remain for some time, and investors would possibly try to identify these, really cheap stocks, many of which still remain in these markets.
Okay. Just trying to understand, Manishi, so you're saying that world was underweight China, the cover-up is, the move right now is expected. In terms of flows or, moving away from India as a result, how long do you see that continuing? And what happened to the inherent strength of domestic investors and retail inflows coming in large numbers? Why is that not helping us now?
It's difficult to put an exact timeline as to onto this phenomenon, how long this would last and when would the interest in India would exactly come back. But, I think if you look at the longer-term average premium that India used to trade at, let's take sensex or nifty compared to MSCI Asia Japan, I think a 10-year average premium was somewhere around 40%, somewhere between 40 to 50%, which had gone to about 100%. And now that same premium has declined to somewhere around 60 to 65%. So it's getting there. It's coming back to the longer-term average. Now, the remaining part of this valuation correction, exactly how that would be, is difficult to guess. It can even be in the form of a time correction, where sensex, which is down close to about 80,000 or so, drifts, for about a quarter or two, while the North Asian markets continue to move up. So the valuation correction could continue in the form of a time correction for India for some time. Now, the second question that you talked about, in terms of domestic investors, that resilience, I don't think the resilience of the domestic investors or the quantum of money that they're putting in through the SIPs or one-time investments, that has really gone away. It's early days in this correction. We have had this correction for just about a week or, maybe just more than a week. The basic driver of these domestic allocations, that the domestic investors are still underinvested in equities, just about 5% of their savings are in equities, that still remains correct. Now, everyone would possibly be looking at the interest rates. Now that the Fed has started reducing interest rates, the RBI may not be far behind. If that happens, you would see fixed income investments becoming relatively less attractive, and therefore equity investments becoming all the more attractive in the medium term. So that could turn out to be a trigger.